have.
Thank you, Mr. Ullman. Appreciate your being here. Ms. DeVito, start with you. Senator Scott said, and factual, no depositors ever lost a penny on uninsured deposits in 9 decades, but we've seen several systemic risk events during the '08 financial crisis and the recent bank failures. The failure of First Republic resulted in increased concentration at the biggest bank in the country, way above the 10% cap, perhaps. What have these events, Ms. DeVito, revealed about the strengths and weaknesses of our banking system and deposit insurance framework? How do other bank regulatory policies help protect depositors and financial stability?
Thank you, Senator. So the crisis this past spring suggests that there are at least, I think, 3 underlying vulnerabilities in our banking and deposit insurance systems. The first is that it revealed depositors are incredibly flighty under the current deposit insurance terms, and that these depositors can threaten financial stability. The second, I think, is that it casts doubt on how effective depositor discipline is right now. We saw with SVB that even large depositors don't currently seem incentivized to or capable of policing banks the way we would need them to maintain financial stability in the long term. And third is that it does seem to be exacerbating rising bank industry concentration through both mergers, as Mr. Frazier mentioned, and deposit flight. If uninsured depositors at smaller banks feel they need to go to larger banks to get that sense of perceived safety, that can exacerbate bank industry concentration as well. In a vacuum, as deposit insurance expands, it removes incentives for depositors to monitor banks. But depositor discipline is only one input into overall market discipline for banks. So bank regulation and supervision play a really strong role in ensuring that banks are operating safely and soundly.
Thank you, Mr. Fraser. When people put their money in a bank, we want it to be reinvested in the community. We want it, obviously, most importantly, to be safe. Talk about why deposit insurance is important to consumers and small businesses, also how it's critical to the role of community banks like yours.
Thank you, Senator, for the question. And deposit insurance is part of a backbone of what I call the banking contract that we have, and it requires banks to operate in a safe and sound manner, to protect consumers and small businesses especially, and to facilitate and provide access to credit. So deposit insurance enables that, along with access to other liquidity sources and such. To the extent that consumers can rely on that and they understand that, then banks have that obligation to perform those 3 activities I talked about. I am growing increasingly concerned, however, about the rise of bank-like services that have the attributes and look and act and talk like a bank and create consumer confusion. And in particular, about 45% of the accounts opened just this year alone are in these bank-like entities, and I'm worried about where that boundary line is.
Thank you. Back to you, Ms. DeVito. Over the weekend, the SVB failed. I talked to many small Ohio businesses who were worried about their ability to make payroll. What are the benefits of expanding deposit insurance coverage for all demand deposits, and what are the downsides that we need to account for and other policies that might mitigate those concerns?
One of the most important benefits to expanding deposit insurance is that it would reduce the likelihood that depositors panic, and so reduces the risk of bank runs. If deposit insurance were to be expanded, for instance, to all non-interest-bearing accounts, which represent accounts that people use to keep their money safe and accessible rather than as a source of investment, then any depositor with balances over the cap would benefit. Minimizing the number of depositors who could initiate a bank run would enhance financial stability objectives as well. Some of the downsides include that as deposit insurance expands, you could increase moral hazard. This effect, though, could be offset through other mechanisms such as tightening banking regulations and supervision, revisiting capital requirements and liquidity regulations in particular. And then coming to consensus on eligibility is a challenge. We need to make sure that whatever terms to FDI reform occur are enforceable through the FDIC and verifiable and communicable by banks to customers and by the FDIC to banks.
Thanks. Last question, Mr. Fraser. Uninsured deposits have been trending upwards since the '08 financial crisis, as you know. We've seen more migration to non-banks, as you point out in answer to the last question, in shadow banks that are not insured or regulated like traditional banks. What risk does this pose to consumers, banks, and the whole financial stability of our system?
right? It comes down to where expectations begin to evolve about what is insured and what's not insured, and what can happen when deposits migrate outside of what I call the regulatory perimeter, that is to outside of where there's oversight, where a regulator, a prudential regulator can monitor those activities related to consumer protection and safety and soundness. There's a risk for customers to suffer adverse behavior or things in that regard. But more importantly, it poses risks outside of the system so that if a non-bank entity were to fail, a payment processor or someone were to fail, what are we going to do as policymakers to solve that problem? And I think as we think about deposit insurance reform, the lines need to be bright and clear as to what's inside the perimeter and what's outside of the perimeter. And I could tell you a quick anecdote about that, but maybe I'll do it separately, where we had a customer of ours go to a payment type system and said, I'm not worried about it because I expect if something goes wrong, someone will bail us out and help. So that expectation's evolving, and I think we just got to have a bright line as to what's in and what's out.
Thank you. Senator Scott.